Kia ora and welcome to Shared Lunch, brought to you by Sharesies in association with BusinessDesk. Before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Today, we're joined by Dr Sebastian Gehricke from the Climate and Energy Finance Group. Welcome, Sebastian.
Kia ora. Lovely to be here. Thank you for having me and allowing me to share some of these thoughts with everyone.
Oh, look, it's such a pleasure. And how cold is it down in Otago? Are we still feeling like wintry down there, or?
Yeah, hey, it's been strange, eh? We had a snow dump last week, and then 2 days later, I was at the beach getting my tan on. So it's been an interesting spring for sure. Today, rather cold, but yeah, a few sunny days in between on the weekends, hopefully.
Yep, these transitional seasons are always weird. You don't know which season it's going to be when you're getting dressed for work in the morning.
Yeah, for sure.
So you're a little bit of an ESG expert. There's huge interest in ESG. It's sort of, one of the hottest trends probably in investing right now, other than trying very hard not to lose money. But it's a very big category, and there are lots of different things within it, and it means lots of different things to different people. Can you attempt to define it for us? Share what your definition of ESG is when you think about ESG. What is that?
Yeah, I'd love to. So for those of you that don't know, ESG stands for environmental, social, and governance. So really, when we're talking about ESG, which is this sort of hot term that's being thrown around, we're talking about either, really including that in the investment process or potentially the reporting of that type of information. So when we talk about, say, responsible investing, it's the idea of incorporating the environmental, social, and governance performance or risk of a company in your investment decision making. Now, there's different sort of words that are used. So there's responsible investing, there's ethical investing, sustainable investing, socially responsible investing, and they sort of all mean a similar thing, which is the inclusion of ESG information in the investment decision process. So not just including financial information, but going beyond to also look at the environmental and social risk. Some definitions talk about, so for example, I've got my notes here, the Forum for Sustainable and Responsible Investment said that it was about, creating long-term competitive financial returns and a positive societal impact. Now, I would say most ESG approaches are not about creating impact. It is about minimizing risk or increasing financial performance, right? And really, there's a spectrum of what we'd call maybe sustainable or responsible investing. And at the one end, you have your sort of value-based investment. And so value-based would be, the pure value-based would be a traditional investment where you don't think about these things at all. And at the other end of the spectrum, you've got your values-based, right? Values being what you care about as a person. And so as we go across the spectrum, we incorporate these, these data points, this information more in our investment decisions. So at the start, you might just take out some bad companies. Then you might actually invest more in, better performing companies based on, whatever ESG metrics you're looking at. All the way to, sustainably themed funds where you're only investing in, say, renewable energy companies. And then there's sort of this another category, which I think there's actually quite a strong sort of boundary to the rest of them, and that's called impact investing. And impact investing is about not just the financial, risk and opportunity that incorporating environmental and social data points or factors into your investment decisions, but actually generating an impact on the environment or society, a positive impact through your investment management and decision making. So I think that's sort of the spectrum, and what it's usually defined as. Most of the time when we talk ESG, we're talking about a type of risk or performance indicator.
Mm-hmm. Yeah, so that idea of thinking about non-financial risks, thinking about sort of non-financial attributes of a company. How new is that? We sort of this umbrella term ESG is sort of booming and feels relatively new, but that idea has been around for a long time. You might have heard Buffett talking about it a long time ago. How new is the ideas contained under the ESG umbrella?
Yeah, so I think, socially responsible or responsible investing has been around for actually a very long time. And it started with actually religious institutions. I don't have the dates at the top of my head there in my lecture slides, but it started with excluding companies that don't align with the values of a religion. Right. And then it sort of grew, and in sort of the 90s, it was quite big in terms of socially responsible investing, or corporate social responsibility was sort of in the late 20th century, was a bigger issue. So around how corporations think about these things. But I think the sort of ESG term has been around for less than 10 years. And the real boom in this industry I put it down to around about 2015, when three key things happened. So the Paris Agreement was signed. So most of the nations of the world agreed to do things to reduce our emissions and therefore combat climate change. We also had Mark Carney, who was the Bank of England governor. He gave a famous speech about climate change being a financial risk, and he categorized it into various types of climate change risk. And in that same year, we also had the development of the UN Sustainable Development Goals that help us align our government policies to sustainable and equitable outcomes for the world. So I think it sort of started around then, and since then the industry has taken off. So as of the last sort of report that I read, it's more than half of New Zealand assets under management are now, and I use this word intentionally, claiming to be investing responsibly. Yeah. And globally, it's around $40 trillion US, which you could look at about a third of all assets under management in the world. And in the US, it's about a third as well. So again, this is the amount of money that's being managed, where the manager is saying they're doing so responsibly. Yeah. Mm-hmm. And again, it's they're saying or they're claiming is quite important.
And when you say claim, are you implying there that some of them have the label and are not doing the work?
Oh, yeah. Now I have to be careful here how I explain this, but I believe, my opinion is that that the idea of sort of greenwashing or impact washing, that's a real problem in the industry at the moment. So many studies that have been published in the academic literature have looked at, for example, US fund managers, and when they sign up to the United Nations Principles of Responsible Investing. So that's essentially the 6 principles. Effectively, what they're saying is we're going to invest responsibly and promote, this approach to investing responsibly to other people, fund managers and stakeholders. And so you would expect that those funds that sign up to that, would outperform based on various ESG measures. And so there's been quite a few academic studies that have shown that UNPRI, so these signatories to these principles, actually underperform based on ESG metrics, right? And different studies using different metrics finding similar conclusions. One study, interestingly, showed that that's more of an issue in the US as compared to for European fund managers, right? And they put that down to sort of potentially a cultural difference, different public pressures, different regulatory pressures, especially now with the EU really pushing the sustainable finance regulation agenda.
Because that's one of the questions I had for you is ESG either over or under regulated, as regulators try and get their head around what is and isn't ESG? And obviously it's a broad umbrella, people want to use the labels. Does it need more regulation or does it need less regulation? You let the market decide. What does the regulatory framework look like to you?
Yeah, that's quite a complex thing to unpack, right? But I think we certainly need more regulations, and we need better enforcement of the regulations that already exist, right? So regulations for me that we need in the space are mainly around transparency, right? So if you say you're doing something, you have to be able to back that up, right? And the way you even describe what you're doing should be understandable and clear what that means, right? So recently, the FMA did a review of, I think a fairly small number of New Zealand investment funds, looked at how they talk about, their ESG approach essentially, and they found that just in the way that they describe what they're doing, that's too unclear, right? So I think there needs to be more regulation around what you have to disclose as a fund manager, but also as a company. And for companies, we've got that coming through the climate-related disclosures. We can talk about that later, maybe. And for fund managers, we also need this. So in the EU, they have what's the acronym is the SFDR, the Sustainable Financial Disclosure Regulation. That's effective, I believe, at the start of next year, where funds have to disclose what proportion of their portfolio revenues, so the company's revenues within their portfolio, are what they call green taxonomy aligned, right? So how much of those revenues are generated from activities that can be labeled as green under that regulation. So something like that is really useful. Now, the fact that the fund managers don't really have that information yet is a whole nother issue, right? But they have to start estimating it, and companies will have to disclose that soon as well. So it's coming, but I think the key bit is transparent information for investors so that they can decide what they want to do. Because many surveys globally, and even in New Zealand, Mindful Money has run annual surveys, and the amount of retail investors, KiwiSaver investors in New Zealand that want to invest responsibly is about 3/4 now. So it's been increasing steadily. But at the same time, I think a quarter of the respondents to the survey said there wasn't enough adequate options. And then about a half said they weren't sure what they were getting with these products, right? So there's real concern there. And so I think that's where regulation and enforcement can help.
Yeah, because it's interesting that it is such a technical space. Even having words like green taxonomy, it's very hard to understand sometimes, and therefore pretty tricky to work out which funds are doing it for real and which ones just have the prettiest marketing documents. So that's like a big struggle. We should talk about your report. You just did some research. What was that about? What were that key findings? Can you do us a 30-second summary of that?
Or 30, maybe 60.
60 seconds, sure.
So we have we published what we call a working paper. So it's not yet published in an academic journal. It's still a work in progress, but we thought the findings, sort of the preliminary findings, were interesting enough that we wanted to share that and raise this concern. So the paper is called "In Holdings We Trust: Uncovering ESG Fund Lemons," right? And basically what we did is we surveyed fund managers in Australasia that are available to New Zealand retail investors, right? So anyone listening to this podcast, these are funds you could potentially be investing in. About half responded, which was really good. And we talked about, we looked at what are their investment approaches, what do they say they're doing effectively. And then what we did is we actually got data on what was in their portfolios. And we ran some analysis to try and look at, what are they saying versus what are they doing, right? And so I'd like to highlight some of that. So in the
how did they stack up?
Part, fund managers seem to be driven by value rather than values, which didn't really surprise us, but it's nice to show that again. So basically, most of them are doing ESG investing of some kind, either because they believe it'll improve their financial performance, or, and this is the important part, because they will attract investor flows, right? So investments from their clients. And that's what's driving the fund manager. However, some of the people listening or interested in doing this are probably driven more by their values, right? Like, yes, we want financial return, but we may also be interested in how are we earning that money, right? Are we earning money off the fossil fuel industry, which we know is destroying the planet, for example? Then we went a bit deeper and we asked them, well, what are the most important issues across ESG to the fund managers? And the top theme was climate change, right? Even beyond all the governance themes. So that was really interesting. But then when we asked them to provide what I would say is a pretty easy to calculate climate risk metric, which is called the carbon intensity. It's essentially a proxy for the amount of emissions in your portfolio. And we gave them the formula, we told them how you calculate it, and if they're doing any of this stuff, they should have the data available. And less than half of the respondents actually gave us that metric. And then when we compared that to how we calculated it, about half underreported, so understated how much emissions are in these companies.
Yeah.
So then we went further and went digging into the holdings some more. And one of the really interesting thing is those funds that said they have signed up to some sort of climate initiative, right? So it's a coalition of investors trying to fight climate change. There's various different ones. If they've signed up to any, they actually have higher emissions in their portfolio, right? So that's, very much relative to those that haven't signed up, right? So that's very much showing that action of signing up to these initiatives doesn't necessarily mean the fund manager is reducing climate risk in the portfolio. And
What's
again,
your theory there? Do you think those people are signing up in an attempt to signal something that they have not yet done their work on, sort of playing catch up? The ones that have done work maybe don't feel the need to sign up to something to show their progress. They can actually show progress. What's your theory there? Why?
Yeah, bit of both maybe, right? So I always say there's probably some, disingenuous people that are doing this, knowing that they aren't actually delivering on what they say they're delivering. And then I think there's also still lack of capability, right? I mean, this is something that hasn't been taught at universities for a very long time. It's only just starting. This is the methods around how to do this are still developing. My issue is, well, don't overstate what you're doing before you can show that you can do it, right? Some of the other findings were, those fund managers that, prioritized climate change over the other ESG themes didn't have lower emissions either. They had about the same. Or the other thing was that even funds that said that they do what's called a decarbonization strategy. So that means that's defined as we will reduce emissions in our portfolio. They actually didn't have lower emissions than other fund managers either. So, there's a lot of sort of initial evidence pointing that there's an issue in this industry in New Zealand. And we're currently diving deeper, so a new version should be out soon. Yeah.
Okay, interesting. So it seems like what your research has found that there are, in fact, a lot of lemons.
Yeah, there seems to be an issue across the industry.
Yeah.
Now, our research is anonymized, right? So we're not pointing fingers at anyone specifically. It's a systemic issue.
Okay, well, that was my very next question. Which ones should we avoid? But we can move past it. Yeah, interesting. So it's interesting to hear you talk about that. People are signing up to ESG, responsible investing commitments, but perhaps not following through with them, and perhaps not decarbonizing as much as you would think. It strikes me, and correct me if I'm wrong here, but I feel like a lot of people who want an ESG fund and want to have a responsible manager, they're really top of mind for them is climate change. They're almost asking for a low carbon portfolio. They probably hear about other things like child labor, but those things are usually avoided anyway. Do you think there's a mismatch between what ESG might mean to a fund manager and what ESG might mean to a consumer?
Yeah, I think so. But, again, looking at that Mindful Money survey, there was actually a fairly good understanding of what is, responsible investing or ESG investing. Most of the respondents pretty much knew what that meant. I would say most fund managers are aware of the definitions, particularly if they're claiming to do this stuff, right? So again, I think it's not so much a mismatch of understanding of what that thing is, although I would say retail investors probably, the audience here probably believe that, excluding certain companies or overweighting well-performing companies in a listed equity market portfolio will improve the world because that's what they're being sold. Now, I would argue that if I buy Tesla shares or my fund buys Tesla shares or even, a bunch of funds from New Zealand buy Tesla shares, not much happens to the world because another investor is just selling those shares, right? And so for these approaches to have an impact on the environment and society, what actually needs to happen is a collective divestment or investment, right? So divestment, so that's removing bad companies from portfolios. By bad, I mean, lower ESG companies. So whether they're fossil fuel industries, so the typical example, right? That only helps our climate change mission if enough fund managers do it, right? So it's almost a responsibility. It's something we all have to do. Now, the issue I have with the fund manager industry, what I've seen more and more frequently, is this being sold as, if you switch your KiwiSaver to this other one that incorporates some sort of ESG metric, and, arguably, who knows if they even do it well, but say they do it well, that doesn't necessarily, directly affect the world. So that's why I said at the start, there's this, unique category called impact investing. And these impact investment funds, they have a direct impact on the environment and society because they actually provide additional capital, right? So they give money directly to, say, a solar farm or a community housing project or something along those lines. So, we have greenwashing, which is what that paper kind of looks at, and there's issues around that. But even more, I'm seeing this problem of impact washing, where funds will claim to have an impact on the world when all they're doing is just weighting their portfolio, so investing more in high ESG companies, which is a financial risk performance exercise. It's not an impact on the world, right? Now, it might mean that you are now earning your returns from companies that are more, those companies are impactful. So you're not earning money from bad things. You're now earning money from good things, right? So you could at least say that, which is what I would call impact aligned. But proper impact investing is impact generating. So we're actually doing something additional with this money.
Okay, so on one hand, the first group, you're not profiting from fossil fuel, you're profiting from good activities, but neither are you generating new good activities. You're just profiting from existing ones. Impact investing, you're actually using your capital to create new positive outcomes.
Exactly.
Yeah.
And we need both, right? Like, I'm not saying everything should be impact investing. I mean, that would be a beautiful thing, but that's unrealistic. But if we shift the whole investment industry towards more capable ESG investing, that collective of change will have an impact on our planet and will help us in our climate, our battle against climate change and other issues, right?
Yeah. Okay, interesting. And I guess another hot topic is, you hear a lot of people pitch this idea, do good while doing well, don't do well while doing good. The idea that ESG not only is good for the planet, is not only feel good, warm and fuzzy, but also delivers a high return. As something of a cynic, that worries me, right? Because why pitch yourself as being a responsible investor, an ESG investor, if it also makes the maximum amount of money? Why not just make the maximum amount of money and coincidentally has good outcomes? Do you think that it's true that ESG funds outperform? And if not, why do people say they do?
Yeah, great. So if we look at the academic literature, which is where I usually try to draw these types of conclusions from, because they tend to be a bit more rigorous than prospectuses from specific funds or data providers. So if we look at the academic literature, the evidence seems to point to, across thousands of studies now, seems to point to the fact that incorporating ESG factors will either lead to outperformance or similar performance, right? So it's in most of the studies, it shows that there's no negative relationship. There's either not a relationship or a positive relationship, right? So the way I'd put it is do well while not doing worse and potentially doing better. And this is based on historical data up until this point. Now, if we start thinking about, well, okay, what's the future got? I don't have a crystal ball, but we can start thinking about what's going to happen in the future. Do we think environmentally, socially conscious firms are going to outperform in the future? Do we think climate change is going to become a bigger and bigger real impact on our portfolios in the future? And if you think that's the case, then that relationship is only going to become more positive in the future, right? So the historical evidence shows there's either no or a positive relationship. And my expectation of the future is that that positive relationship will just become stronger. There's also some research that's shown that actually, higher ESG companies have outperformed in times of market turmoil, right? So when there's market downturns, for example, they looked at, I believe, the COVID pandemic, that crash we had, although, all the money printing brought it back pretty quickly. During that short period of market downturn, ESG funds high ESG companies outperformed low ESG companies.
Mm-hmm.
Now, an interesting thing around all of this is, of course, how do you even measure ESG, right? And that's a whole nother can of worms.
Yeah. Let's jump into that in 1 second. But before we do, let me push back on the idea that ESG funds will outperform, because you could equally argue that so many funds are chasing ESG now that companies that have high ESG metrics, good ESG performance, will now have a valuation premium over top of poorly performing companies. Poor companies have a discounted valuation. High ESG companies have an elevated valuation, which could ultimately mean that while ESG funds have outperformed to date, from here, now that there's so much funds invested in ESG, the ESG companies will permanently have higher valuations and therefore deliver less returns, while the investors who are willing to sacrifice on their values might get an extra return from a fossil fuel company. What do you think of that idea?
Yeah, I mean, there's sort of theoretical models talking about this in literature as well, right? So it's this idea. So if we focus on climate rather than the broad ESG topic, because climate is sort of the most pungent risk, right? So if we think about that, there's this idea of either a carbon premium, right, or a carbon alpha. So a carbon premium would be, in order to invest in these lower to get into these lower risk, future risk climate companies, because everyone wants to do that, the prices come up. So actually you lose some return in the future. And the carbon alpha is, well, what I described before, right? There's going to be outperformance in the future. And actually, if we think about it, if there's going to be even more people investing in this way, then the alpha is going to keep being positive for a while, right? So the New Zealand Super Fund, for example, started their inclusion of climate risks and opportunities in their responsible investment framework, I believe in 2017 or 18, right? And that's because they believed climate change was not yet priced. I believe climate change is still not fully priced, right? So I understand your argument, but I think we're not there yet, right? There's many more regulations and many more risks that are not yet fully incorporated in valuations. I mean, even in terms of how you incorporate climate change risk into a discounted cash flow valuation, right? One of these financial models we use to value a company as analysts or investors, even that's still involves a lot of qualitative thinking, right? And so even though there's certainly going to be hype around certain stocks, and that's always going to be the case, and there's going to be short-term fluctuations. But if we think about a long-term trend, right, like this year, you would have done really well if you'd been invested in fossil fuels, right, because of the Russia-Ukraine thing. But if we think ahead, I mean, if I'm thinking about my KiwiSaver, that's going to be in there for another 35 years. Climate change risks are probably going to only become more real, and the realizations of them are going to impact these companies. So I do not want to be invested in fossil fuels, even from a purely financial perspective.
Yeah, I think it's probably a safer bet that governments will not take enough action on climate change than that they will accidentally take too much action, and climate change will turn out to not be such a big deal. Okay, we should go to questions pretty soon, but first let's open that can of worms you just referenced. There are a lot of ways to measure ESG. There are a lot of providers who want to be the premier ESG data provider, but they all give slightly different scores about different companies. What's up with that? Why are the ratings different? How can we trust them? Is ESG something that's subjective rather than objective?
Yeah, so I think there's certainly a lot of evidence around what we call the divergence of ESG ratings, right? So the classic example that I think was in the Wall Street Journal a couple of years back was, Tesla being ranked lower than ExxonMobil by 2 out of 3 of the ESG providers they were looking at, right? So that's a classic example. I mean, hopefully most of us think Tesla is at least more sustainable than Exxon, which is an oil and gas producer. So if we think about that, what's driving that? Well, there's certain biases in ESG data, right? So there's, for example, larger companies tend to have better ESG ratings. Also, companies connected with the ESG raters tend to have better ratings, etc. Right? But the divergence, what's driving that, is also, there's different providers are trying to measure different things. So I guess it's what you're saying. It's these ratings can be subjective, right? So some providers, like for example, Sustainalytics, is looking at unmanaged ESG risk, right? So the whole ESG risk, but the component that the company is not actively trying to mitigate, right? It's unmanaged. Then there's other companies that look at ESG performance, and then there's even other companies that look at, how does this company affect the environment and society rather than just the risk or performance side. And then you also have issues around, crazy incentives that causes ESG raters to backfill data so that their data is more appealing to fund managers. This has all been documented in the literature, right? So the issue is that different ESG scores are measuring slightly different things. There's no sort of standardized way to measure the ESG performance of a company, right? And so some of the approaches to mitigate that is either you take the 8 most prominent ESG data providers and take an average across the different providers, and that'll give you a more intrinsic ESG performance metric. Or you go deeper, right? You look at, what do you really care about, right? So do you care about climate change? Well, then maybe you want to be looking at emissions, fossil fuel reserves, things like that. Maybe you care about water use or the amount of renewable energy that these companies use, right? So that the data is getting better. Another issue is that a lot of these companies aren't disclosing the data that the providers need in order to create the scores, right? So the scores aren't overly reliable, but they're better than nothing. Yeah. And ideally, you would look at several different scores to get a better idea. Or if you want to go deeper, you find the underlying data, which the data providers provide as well. However, for our listeners, before we get too technical, I've just caught myself in that a little bit, I think. A really useful resource to see what your fund manager is investing in for you is to go to Mindful Money. Right? So if you Google Mindful Money, they provide the exposure to fossil fuels, weapons, pornography, tobacco of all New Zealand funds and all New Zealand KiwiSavers, right? So at least you can get an idea of what those funds are exposed to. Then you could look at, what are they saying they're doing versus what Mindful Money tells you they're exposed to, right? And then you might have a question for your fund manager and you could ask them, right? Or you can switch funds to something that's more aligned with your values. So that for retail investors at this stage, the best thing to look at is exposure, right? Because the deeper analysis has not been refined enough in order to disseminate it to the layman audience, right? In the academia, we're working on how to do this. Even in the industry, we're working on it. I'm sure Mindful Money is working on it. But at this stage, it's the best thing you can do is, what's my fund invested in? I'm going to ask them about that. Do I like the answer? Or I'm going to switch funds to one that's not invested in things I don't, appreciate.
Yeah. Okay. Cool. We should jump into questions because we've got quite a few coming through. So the top one is, do you think an accreditation system like you see Fair Trade on coffee would be helpful for the industry? And is there any attempt to create something like this?
Yeah, so there are accreditation systems out there. For example, Mindful Money, I think, gives like a fossil fuel free tick and a weapons free tick, something like that. So that helps. There's also the Responsible Investment Association of Australasia, and they do responsible investment certification. Now, the only issue with certifications in my mind is I think they're useful, right? So it's part of the picture. It gives you part of the information. But the issue is that the methods for measuring the stuff aren't perfect yet. So how can you say that this is definitely a responsible fund, right? So it's hard, but it's better than nothing. Again, it's all of these things are developing and getting better. So we should use them and then reevaluate next year or in a year's time and see if there's new tools we can look at. And they are getting more sophisticated. Now, I would also always with these accreditations, it's worth, whether that's B Corp or RIA, responsible investing accreditation, or whatever accreditation, because there's actually a lot out there. The first question I always ask is, how does the accreditation body make money, right? If they are paid by the people they are accrediting, that creates a conflict of interest. Doesn't mean it's not perfect, it's not good, but it just gives me a little caveat when I use that in my decision making. So for example, Mindful Money, it's a not-for-profit. That's great. And I'm not sure exactly how they're funded, but that's my go-to in New Zealand anyway.
Yeah. Okay. That makes sense. What's the next question to go to? A question about your research itself. Someone asks, there were 0 scenarios where funds focused on ESG could lower their emissions below funds that don't focus on ESG. Why do you think that is? Was the research based on intensity or absolute emissions? Intensity of emissions or absolute emissions?
Yeah, so I think you're referring to, so one of the findings in the paper, for those that haven't read it, this asker may have, which is great, thank you.
Sounds like they have.
So, we looked at, beyond all these other variables we've already talked about, we also found that funds that have sort of ESG labeled don't actually have lower emissions than the funds that aren't ESG labeled, right? Which was surprising. They have statistically, it's not different. And so what we used to answer the second part of the question is we used emissions intensity. If you use straight emissions, then the size of the fund will bias those results. So you have to create some sort of proportionate measure. So emissions intensity is the emissions divided by revenue in this case. And so that allows you to aggregate that metric across all of the companies in the portfolio. And, a larger company is not contributing more than a smaller company. It's purely on, how much emissions do they have per dollar they earn, right? So that's a pretty good measure used at the moment. I could go on for hours about all the other measures that we're working on for the extension of that paper.
I'm sure. Robert asked an interesting question about everyone's favorite stock, Tesla. He says, where does this type of measure apply to someone like Tesla, where the mineral cost of producing lithium batteries create a lot of carbon emissions, but obviously the cars themselves don't? How does that sort of, what you might call scope 2 or scope 3 emissions factor into these ratings?
So that's tricky, right? So I think Tesla, they're building EVs, so that's going to decrease emissions. But then the process of creating the EVs actually has a lot of embedded emissions, right? And that's why I say, just replacing all our cars by electric vehicles isn't going to solve the problem. It's not a silver bullet. Now, building EVs is part of the solution, right? I think it's part of the way forward. And the thing with lithium is currently the way it's extracted does have high emissions. It also has other environmental negative impacts. There's actually a company in New Zealand, unfortunately not listed, so none of us can invest in it. And I forget its name, but they are working on a technology where they are going to extract lithium from the geothermal liquid that they're using to generate power already. And so there would be actually almost no additional externality to that, because the water's already pumping through. So that is currently, I think, a promising way to generate what we'd call, sustainable lithium. Just on Tesla, it's quite interesting. The ESG scores of Tesla are quite low. And the key driver of that is that Tesla does not disclose, sustainability strategy, climate targets, all of these disclosures that ExxonMobil, for example, spends a lot of money on. And that's because Elon Musk says, well, we're an EV company. We have to disclose our, climate strategy, etc. We are a solution. However, whoever asked this question, you can kind of see through that, because there's scope 3 emissions, which is the emissions from, the products you use and buy. What emissions did they generate? And when you sell something, what emissions does that generate? Right. So for the lithium, that's generating emissions. Even building the car might be generating emissions, the steel, etc. Yeah.
Mm-hmm. And I would imagine Tesla doesn't score well on governance either.
Yeah, I'm not sure, but I don't think it's great. Yeah.
Well, try not to defame anyone, but I believe the quote was, "I don't respect the SEC." Just not something you'd catch me saying in public.
Yeah.
Look, I had a question that I've been thinking about lately, and I think it was flagged in some notes somewhere. There's this idea that weapons are obviously not an ESG, not favourable in responsible investing, but it feels like there's been a tiny bit of a shift on that lately when suddenly weapons are flowing into Ukraine for a cause a lot of people support. You can argue that there's being positive impact there because democracy is being protected. Is there any shift on the idea of whether or not weapons can be included in an ethical portfolio?
Yeah, so there has been discussions around that. Now, the way that the easy answer for me to say is, it's what is your value, right? So for me personally, I would rather not have weapons manufacturers in my portfolio because I believe, okay, protecting democracy, it gets very complicated very quick, right? Geopolitics, is it a good thing? I mean, that's a whole nother question, right? And so those are subjective ethical debates. And so you have to decide for yourself, do you think weapons manufacturers, they've never been seen as a good industry, really, as an ethical industry. And we've had plenty of wars, and plenty of them have been claiming to, and I'm not saying that this one is not, but claiming to protect democracy. And we've never said, oh, well, that means weapons are good. So, to me personally, I think, weapons manufacturing should be not even a profitable industry. It's something that governments do to protect their democracies, not something private manufacturers should do. But that's my opinion, right? And that's my knowledge on geopolitics and war and the ethics of it is not that deep. But for my portfolio, I would like there to be no weapons manufacturers. So I'll go to Mindful Money, I'll find one that doesn't have it, and then I'll go with that.
Yeah, we better wrap up. But before we do you want to give a little plug to your new finance course in Otago?
Please, thank you. I mean, as you can probably notice, I'm a bit of a lecturer, which is good that I'm in this job. And I'm happy for anyone to send me further questions via email. You can find me on Google, etc., LinkedIn, whatever. But we at Otago University, we have as you can see behind me, the Climate and Energy Finance Group, and we do a lot of leading research in this space. And we're now also leading the development of curriculum. So last year, I launched a course in sustainable investing, a third-year finance course. And as of next year, we will have a sustainable finance minor at Otago. So if you or your kids or your friends or anyone is interested in learning about the stuff and getting credentials in what's becoming an industry, filling up with new job offers or new job opportunities, I guess, then check it out. I think you can just Google Sustainable Finance Minor Otago and you'll probably find the information. But again, I'm very keen to always answer people's questions on that or anything we've discussed today. And I believe that there's going to be more guests talking on this topic soon. So I'll be tuning in for sure and asking questions myself.
I think so. All right. Well, thank you so much, Sebastian. It's been awesome having you on. And as you say, this is a big topic, so we're going to have to go into it again. Maybe we can even have you back on. So yes, thank you, Sebastian.
Awesome. Thank you very much. Ka kite, everybody.
Thanks for listening, and a big thanks to Dr. Sebastian Gehricke for joining us. If you're not following the podcast, you can do so on Apple or Spotify or wherever else you get your podcasts. Leave us a rating and a comment with who or what you'd like to hear about next. Next week on Shared Lunch, we speak with Jonathan Oram, CFO of the Warehouse Group, on supermarket shakeups, the soaring popularity of click and collect, and how the multi-billion-dollar retail giant is faring after a rough start to the year. Register for that discussion on Crowdcast so you can hear the conversation play out in real time and get your own questions answered live on air. The link is also in our podcast description. Until next time, enjoy the rest of your week and stay safe.